Let's bring in Ryan Lamant. He's the advisor to the board at Security Capital. Ryan, I take you to a story over the weekend that ruffled the feathers and got quite a bit of traction. This is a view on the macro for 2023 from StoneX Financial, saying that a decade of 4%, 5% inflation is really not bad. We are in a period where we have a structurally tighter labor market, mostly because of demography and also because we no longer have access to Mexican labor. Does that mean that the Fed, maybe mid-2023, abandons its 2% target?
Good morning, gentlemen. That's very hard to say today because the Fed has been sending messages right, left, and center that they are adamant on breaking down inflation to 2%. Now, labor market is not only tight because of the Mexican border or other stuff. It's also because of the labor participation, which is in the low 60s. We need to see it again back in the higher 60s so that the job market relaxes a little bit.
Ryan, good to see you this morning. When you look and you listen to Larry Summers, he's still saying that we're in a dangerous territory. Rates need to go higher. You've got Randy Krosner saying the Fed needs to keep going until they crack or break something, which they haven't broken anything yet. With all of that narrative in play, wages double the expectations. Do we need to reconsider a terminal rate materially higher than 5, but we haven't quite caught up with ourselves yet?
Absolutely, Manus. What happened over the past few weeks is the unwinding of all of the Fed's efforts over the past 6 months, because that rally we have seen in stocks has basically relaxed financial conditions rather than tightened them. And I think the Fed has said that the window for a soft landing is getting narrower. That's very significant for the Fed to say it just a few days ago. So yes, I do think the terminal rate will be higher and for longer, exactly as the Fed is saying it.
Ryan, I look at markets and I get mixed signals on how to price the China reopening theme. In Asia, stocks are getting quite a bit of a boost, but U.S. equity futures are pretty much flat. How do you interpret the news over the weekend?
I think it's good news for China to start to reopen. There's a very nice chart of the world done by Bloomberg. It's sort of a heat chart that shows you PMIs across the world. And on the east side is showing green, PMI growing, and the west side is showing more on the reddish side, which is PMI compressing. So it is about Asia right now. This is where we all have to go, starting with the GCC and then eastwards. Now, let's balance that a little bit regarding China with regards to demand going down, Apple moving away production from China. So we need to balance this news and do some stock picking regarding positioning rather than blanket and re-entry into Chinese stock markets.
Yeah, well, I think BI have run various models. If you run the Taiwan model or the Hong Kong model in terms of where peak cases are, no road is straight. And nor is that true for the oil markets. A nice bounce this morning, up nearly 1%. They rolled it over. A price cap that has no teeth and a China reopening narrative on very thin production, additional production capacity in OPEC. Does that give me $100 oil quicker than $60 oil?
Absolutely. And let's not forget that airlines are still consuming 1.9 million barrels a day less than they consumed back in 2019. So as soon as travel gets back to before, when China reopens and the Chinese start traveling again, the demand for oil by airline companies will spike up again, and that 1.9 million barrels a day will close. So there will be a crunch on oil, and we're more likely to see $100 than 60. Absolutely, yes.
December tends to be a positive month, a strong month for U.S. stocks. So depending on what kind of horizon you look at, I mean, that applies to the last 50 years. On another metric, the last 70 years. You're negative on U.S. stocks. Why are we not going to get the Christmas rally, the big melt-up to save what has been a painful year for a lot of investors?
Well, we are fundamental investors rather than tactical or technical or trading oriented. So when we have a view, it's more of a medium-term view. Yes, December could be positive. We have seen a rally above 4,000. We can see 4,200 even. However, fundamentally, we cannot say we are positive U.S. stocks given the earnings compression, given inflation that is still going up, given that wages has lagged inflation until now. So as soon as we have wages increasing, we could see a wage price inflation or spiral. So there are quite some negative things. And let's not forget the geopolitical side, which is still quite tense. And that is why we're still negative on U.S. stocks over the next coming months.
And I think that's why we may have that Wile E. Coyote moment that Larry Summers refers to, which is we're all trying to do the same thing at the same time, find a job, sell the house, sell the car. One last thing, which is real rates. If we take Fed funds, take away core CPI, you get the real rate. But there's another 100 bips priced in terms of hikes. We could have positive real rates by the end of the first quarter of 23. What would that do to your thesis and portfolio?
Well, as soon as real rates become more positive, that means discount rate is higher. That means I need more revenue, more return from stock markets to compensate me for the risk I'm taking. So these things are normalizing today. We are getting back into the real-time value of money, which we have been missing over the past 10 years. Portfolio management theory is based on the time value of money. So as long as it's negative real rates, we cannot really base our portfolio management on fundamentals or on traditional portfolio management theory. So it's good to see it because this will put us back on track on how we manage portfolios.
Okay, Ryan, active management, there's a gold star in it for you there. Ryan Lamont, advisor to the board of Securrency Capital, with his calls on rates, markets and beyond.